Hi, hello everyone. So let's start discussion on very important topic, guys. It is the part of the Indian financial systems, and this topic will give you the overview of the flow of funds from the saver to the intermediate entity or directly to the borrower. So borrower likes the infrastructure project companies or large the development will happen, and the government body which need to funds to the rural development or the urban development. So these kind of fund needs huge amount of funds. So how they collect the funds and why the retail investor funds come to that investment, what are the routes that and how the flow will happen. So all these things we are going to discuss in this video with direct and indirect finance with the infrastructure focus. So how the if there is a one of the National Highway Authority of India project which required a 3,000 crore to develop the roads for 100 kilometers. So where the source of fund 100 kilometers is come, is that for all the government or any or the private funds, but what the way it is the retail fund, how that funds comes, what are the roots of that fund. So we are going to discuss that thing in this video. So before move into the topic of this video, I would like to request you guys, please do like and subscribe my channel. So that's motivate me to create and more such interesting video for you guys and help me out to get a better job in the market with topmost organization. So that's my motive to create these videos. So let's start discussion on the big questions which if give you the answer for these questions. Suppose if you have the 10,000 and how it reach to company building halfway. So if you have the 10,000, so how that your 10,000 rupees will be reached to the company which are going to building highway like national highway or the NaBFID. So you don't hand cash to NHAI directly. So you don't give go and deposit in the NHAI account or directly to the that project. So there are the certain financial system or the certain routes that need to be flow of your money and directly get to the NHAI account, so that the money flow through the financial system. How that money flow from the financial system, like you directly buy the NHAI bond and that money will directly go to the NHAI, and they will give you the your bond value and the interest rate whichever they define on that bond, and you directly go to the intermediate entity like NaBFID, SBI or the IIFL, so any of that, and to buy their issuance of bond to the related to the government or the road project or the construction project. So that intermediate your money will get to that intermediate entity, and that intermediate entity directly invest into the final of the NHAI road construction project. So there are the two key main routes for your money to flow for the development of infrastructure projects, like direct finance versus indirect finance. Guys, you should understand and be more focused on the direct finance and the indirect finance. So initially we are going to discuss on the direct finance and then we will move to the indirect finance. So in the direct finance, the saver will invest their money in the financial market to the borrowers. So he will go to the borrowers with using the tools like Giroda or the investment tools like the Grow or the 5 paisa, where they can directly buy the bonds or the stocks of that entity where they want to invest. So the key features of this is the saver buyer the financial security directly from the borrower, so they can go and directly uh, buy that financial entity from the borrower. There is a no middleman or intermediate entity. So there is so to take ownership of fund. So there is no ownership of fund will happen directly. The borrower will owner of that your fund. So main platform is the stock market or the bond market. So these are the main two platforms where you go and buy the direct finance for that the investment. So India plus Infra an example. So let's discuss on some example of the direct financing. So NHAI free bonds household buy direct for 20 to 10 to 30 years. So if you go the bond market and buy the NHAI bonds or the Solar Energy Corporation of India bonds for the 20 to 50 years, so that will be the direct investment. So there is no middleman. Also, you can buy the IFRC bonds. So it is and the Indian Railway Financial Organization. So that will issue the bond, raise money for infra role projects. So if they want the huge amount of investment in the roll project, so they will issue the bonds in the market and you can buy that buy a bond directly, and that investment will goes directly to the rail infrastructure projects. And then InvITs, IRB InvITs, Power Grid InvITs, retail investor fund operating through Harvest. So you can go and buy invest InvITs product, investment infrastructure investment trust. InvIT stand for the infrastructure investment trust. You directly buy, and that will be directly goes to the investment. And then the sovereign green bond governing raise money for solar and wind projects. So that will comes under the Solar Energy Corporation of India. So for large and creditworthiness borrower needed funds, long-term funds to grow their business and to generate the profit from them. So let's move on the next route, which is indirect route, where the intermediate entity will involve like SBI or the private firms like SDFC, ICICI Bank, Axis Bank, and the public banks like public banks like the SBI, Canara Bank, or the uh, Bank of Baroda involvement. So where we are going to discuss on where the server and intermediate entity borrower. So the key features of indirect finance is there the involvement of the banks, NBFC, insurance firms, mutual funds collection from several lead and investment that will happen there. So you will invest your money with the particular purpose and understanding objective of that scheme. It's in the scheme, and that scheme will route your money to the borrowers of way. So that's the key features. Then the intermediate does the risk analysis and monitoring. So you don't think on the risk analytics part and the monitoring part, and you don't need to check where your exact fund goes and route it through that borrowers. You just believe, and the intermediate party and intermediate party will do that all things for you, and to take a guarantee to save and safer your money. So that's the important thing, guys. They will take the guarantee to save and safer your investment. So server get save small ticket option, but FD insurance and the PPF public provident fund. So let's discuss on India plus infrastructure example what they are in one. Let's first consider the bank. SBI FD money. So if the customers or the saver of SBI deposit their money in the saving account or the fixed deposit or the recurring deposit, so that amount SBI will take and loan the Mumbai metro project. So if suppose 10,000 crore or the 1,000 crore Mumbai infrastructure project, so that money will lend the SBI to this project, and SBI will be the intermediate entity for such project. Then NaBFID, now development financial institutions takes a long-term fund lead to infra projects. So NaBFID will be the intermediate entity, and then the LIC policy premium investment in power grid corporation bonds. So LIC, the policy premium charge from you that investment in the bonds market to get the return. And the employment provident fund, your PF money, when you are the in monthly PF will debited from your the salary. So that is the PF money funds the highway, port, and NHI bonds So that will go for the indirect financing. Your money will routed to the intermediate entity, which is the employee provident fund organization, and that will directly invest into the NHI bonds or the CEPI bond. So let's move on the next an important topic, that is a direct versus indirect side by side. So let's understand what is the difference between direct financing and indirect financing, and what are the key features involved in the direct and indirect financing. So the India size of the direct financing and indirect financing. So the India size of corporate bond is the 50 lakhs crore, and the bank credit is 180 lakhs crore. So you can see how the use of the indirect financing. It's the more than 350%. So it's more than 350%. And then the risks to sever. So high risk pick the bond and stocks. So it's the high risk for the direct financing. So there the stock will not predict the growth, and the low risk bear the default risk. So here in the indirect financing there is a low risk and the default risk, where the intermediate entity take care of your on behalf of your to save your money. So ticket size large, minimum the 10,000 plus for the bonds. So in the direct finance, if the ticket size of to buy the initial bond papers, it's the 10,000 plus. It's required the huge amount of ticket to buy the finance from the indirect way. And if you go the indirect way, so you just need 200 rupees to FD and also work any amount which is lower for that bank, you just do the FD, or you just keep your amount in the saving account, and bank will routed your amount to their the different ways. Then infra example, buy the NHAI bond on Zerodha. If you go on Zerodha and buy the NHAI bond or the growth or the M-Pesa application, so that is the example. And the NaBFID give loan to the L&T for the road projects. So NaBFID will the source of finance with the bond, debenture, insurance company, or the PF funds, or the pension funds that collect and that directly lend to the L&T road constructions, or the ECP contractor kind of things will happen. Then the key problems for there in the direct finance is the low retail participations. It's less than 10%. So there is no you can say there is no retail participants in direct finance. But in the indirect finance is asset liability mismatch for the banks. So that's is the most and key challenge which faced by the bank is asset liability mismatch. So there is, the liability sides are the lower duration. There is a duration gap, and the assets are longer duration in infrastructure projects. So that's the challenge or the gap which faced by the Indian financial system. So let's move on the why the infrastructure needs both routes. So why the infrastructure need a both routes, direct indirect solution, and the indirect financing and the direct financing. So banks struggle post under the 3 years FD to fund the 25 years bond. So banks struggle, and bank had challenge how they can invest 3 year FDs to 25 years bond, and they don't know the future investment in the FDs, their balance it. So it is challenging for the bank. So it is create and the non-performing assets, or it is create and the asset liability mismatch for the bank. So for that solution is the indirect financing, create a NaBFID or the IFCL for long-term lending. So their role is to issue the bond in the market, or to issue the equity and collect the funds from there with 10 year or the 15 years, and then directly invest in the infrastructure projects. So the solution with direct, so push the InvITs, municipal bond, green bond, so retail saver funds infra directly. So to include the infrastructure for investment trust, municipal bond, green bond, where the direct investor can go and directly invest in that bond. So result hybrid model example of GRM airport funds via bank. So these are the hybrid examples. So let's move on the next slide, which is the last slide and the most important slide, guys, where we are going to discuss on the key takeaway from this video. So the two flow exists. So here the two flow exists: direct market, or direct, or the market, or indirect intermediaries. So you should keep in mind direct is equal to market, and the indirect means the intermediaries involvement. So India reality, 80% household saving go the indirect route via banks, LIC, and the employment provident funds. So our funds will go in these routes in the indirect way. So the infra trade, government pushing direct route via InvITs, bond to reduce, and the bank burden. So government are pushing these the investment rate to the indirect way, where direct investor can invest in the InvITs product, or the stock, or the bonds of the that government body. Why it's matter? Better financial system and cheaper highway. So it's increase the financial system, and the cost of to creating the highway is cheaper, and power, and the power for ports, and the power for India. So that's the key takeaway from this video. So once again, guys, thank you so much for attending this interesting seminar. I am very happy to teach you that key points for you. But I just want to you just like and subscribe my channel, so that will motivate me to create and more such videos, guys. If you have any questions, or if you have any doubts regarding in this video, so please do like and subscribe my channel, and do comments on your question, and I'm definitely try to help you on that part, and get you for the better opportunity, help you for the getting the better opportunity. Thank you so much, guys.